How to analyze volume. Let's dive into it. So first of all, how to read volume. On the bottom, we have the volume indicator up. It can be seen with the green and red histograms. Essentially, if a candle closes green, you will also have green volume. And if a candle closes red, you'll also have red volume. Now, what volume actually shows you is the buying and selling pressure in any given candle. It's the aggressive side. So that shows the market orders that are taking place in each candle. The moving average is your blue smoothed line, and this shows you essentially the average of the volume over a set period of time, which you can customize in the settings. So if the moving average is rising, that means volume over that period of time on average is rising, and vice versa if it's declining. So that gives you some insights into the overall volume picture smoothed out. So, what is the use of volume? Well, it all starts with this question. When is volume doing something abnormal? That's where you get the most bang for your buck when using this indicator. And I like to use this indicator in the following ways. So we have volume harmony. This can help us identify trend, breakout, or breakdown confirmation. We've got volume divergence. This can help us identify a trend reversal signal. And some other methods where volume can be used include support resistance and market liquidity. So let's dive into those. Volume harmony. On screen, you can see that price is in a consolidation. It then confirms a breakout. And on that breakout, you have significantly increased volume compared to all of the volume before it. That confirms that the breakout is valid and sellers are in control, because in this downtrend where price is breaking out, if you have high volume, that means there's high participation and a large amount of sellers are actually participating and giving force to the move. And when you're trading your trend following systems, which will be based around breakouts or breakouts and retests, you want to be following the flows. The game is to follow where the wave of buying or selling is flowing. And in a downtrend, you want sellers, so high volume on those breakouts, and vice versa on your uptrends. And on the preceding legs of the trend, the next breakout and the next breakout, you also want to see volume continually rising. And that shows you that the lower price goes in this example, the more sellers are participating. So there's more effort to continue pushing it lower, which again is volume harmony, because price is moving in a direction where volume is also rising. That is harmony. And the opposite of volume harmony is volume divergence. So this is where price goes higher in this example. Volume, however, goes lower. Divergence. So this shows that buyers are not in control because price is going higher and less effort from the bulls is participating in that price going higher. Therefore, they're not willing to push it with more force. And that can be a sign to look for a trend reversal. Now, of course, you can combine this with other price action concepts. I always recommend to use price first. So wait for your market structure breaks and for clear reversal signs or EMA bands, whatever you use. However, volume can give you that sign that momentum is slowing down. Look for trend reversals. And that can help you with exit rules in your trend following trades and also entry rules in your mean reversion or reversal trades. So that's the volume divergence. It shows you when momentum is slowing. Now, some other methods where you can use volume are as follows. So support resistance. In this example, we have a clear resistance level which continually gets retested and holds. And on this particular retest over here, we can see that it has high volume. Now, of course, price first, as always. You can see price rejects it. But the fact that price rejects it with high volume shows that this level, to a high probability, will hold. Because what does it mean? Well, if you've got high volume coming into resistance, that means there's been lots of buy pressure. And that buy pressure has failed to flip that resistance. So those buyers are wrong. And they've been met with passive supply on the order books. That's your limit side, your passive side, and your aggressive side. That makes a market. So if the passive side is overwhelming a high aggressive side, that shows you the resistance or support is strong and likely to hold. And that can be a trigger for you to look for short entries in this example. Or again, if you're in a long from previously, that could be a trigger for you to actually exit. Many different ways to use it. Now, the last way to use volume is market liquidity. So as you can see, volume's very high at the beginning of this chart, and then it tails off. You see the moving average sharply decline, and volume just stays very minimal and nothing like the previous volume. And you can see price action wise, price starts bleeding, volatility starts dropping, and this shows you what markets you shouldn't be trading in. Because volume literally shows participation, how much buying and selling is going on. If no buying and selling is going on, everyone's leaving the market, there's no volatility. And that means there's no changes in price, or at least the changes in price are small. And as a trader, volatility is your lifeline. You make money from the change in price. So don't trade the assets that have minimal market liquidity.